Hi everyone, this is Jason Barrack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's a former corporate executive. He's involved with the Financial Repression Authority, and he also runs the Macro Analytics and Technical Analysis Strategic Investment Insights newsletter. Gordon T. Long, thank you for joining me.
Jason, always a pleasure. Always enjoy our conversations. And by the way, Happy New Year, and may this one turn out to be financially better even than the last one.
Happy New Year to you too, Gordon. I definitely always enjoy your conversations. I think you're one of the best macro thinkers in our space.
Well, thank you very much.
Yeah,
because you interview an awful lot of very good people, and I enjoy the interviews.
Well, so do you, and I think that's the key is that you have an open mind. So if things change, you're more flexible compared to some of the other people in our space.
Probably because I'm first and foremost an investor, Jason, and making money immediately or losing money immediately tells you where your thesis is wrong pretty quickly.
That's a great point. So before we talk about 2018, let's get your views on 2017. Brief summary of 2017, what the central banks did in 2017, and how you think that'll change or affect 2018 then.
Yeah, a great year, but what surprised me the most in 2017 was the degree of money printing, if I can use that expression. But the increase of the central bank's balance sheet. I knew it was going up, but I think I even underestimated it, the degree of which it would go up, and that's because how broad-based it is. And in January of 2016, as we went into a year before we went into 2017, as you know, the market was starting to come off. We'd finished taper in the United States in late fall of 2014, and the market was really starting to break some pretty critical support. And in that January of 2016, suddenly the ECB really went hard with their quantitative program, their equivalent of quantitative easing, various forms of it, and the Japanese bank. That amount of money printing I knew was coming because of basically Bernanke's enrich thy neighbor policy, a ring around the rosy, that what we'll do is rotate amongst the countries, but we'll keep the overall growth of the total balance sheets in a linear growing fashion. That we've sustained, but I thought it would be a little flatter than it was. So them doing that was not a surprise. The degree of which they did it, overlaid on top of what China was doing, and people don't pay attention to the magnitude they were putting in. So we went to 200 billion, and then very quickly to 250 billion per month that we were pumping money into the economy, into the global liquidity pool, and that flowed through into 2017, as you well know. So I knew that they would start to talk about things like normalization, that they would start, and ECB would start to say we're going to restrict it, but they were so slow in talking about it. Told me the magnitude of the crisis, and the other surprise was. Though I knew it, I believe it's coming, and even in a bigger fashion. But I was surprised when I found that the central banks, the degree to which they officially were buying the stock market, the most blatant being Japan. And that is with them owning, north of 70% of all the ETFs, but they were owning north of 5% of the total Nikkei, seeing what the Swiss National Bank was doing, what the Norway was doing, etc. So you can imagine underneath how many of the central banks are now officially buying the stock markets. But to see them actually coming out into the public forum was a surprise, which means they now know they have no choice but to continue this expansion of the balance sheet, despite what the narrative is right now. And I look at that, Jason, basically at them kind of tapping on the brakes to see if they can slow it. But like if you tap the brakes on ice, you can spin out of control, because we're so highly leveraged and there's such little real underlying collateral that isn't rehypothecated right now, that any kind of collapse, especially if you look at what's going on in the pension plan system, it would be just totally destructive. So a little long-winded, but that's what was really the surprise. And that leads into what we'll see in 2018.
So let me continue to summarize what happened in 2017. So the Dow basically has gone parabolic. It made 71 new highs in 2017. The S&P 500 went up 19% in 2017. The Russell 2000, the small caps did well as well. And basically, you know, with the liquidity program, I've read estimates that it was over 300 billion a month, and that was just from the Bank of Japan, the European Central Bank, and what the Federal Reserve was reinvesting in. Also, the Bank of England too was doing QE, although not as much as the other ones. And so that was over $3 trillion per year on an annual basis that those three central banks put in to asset markets, basically bond markets and stock markets, and that doesn't even count China. And so China, the last 5 to 7 years, China, actually Daniel Lakaye, who I interviewed a couple months ago, he said that in 2017, China put in more liquidity than those three central banks combined. They were putting in.
Yeah, the number I use 250 billion a month, which is your number of over 3 trillion a year, but not including China, and actually not including the the Fed's rollover. So you're absolutely right; it is of that magnitude.
The other scary thing, Gordon, about 2017 was, guess who made the most profits? It wasn't Apple, it wasn't JP Morgan, it wasn't Berkshire Hathaway, it was the Swiss National Bank, who made $55 billion in trading profits out of basically currency they created out of thin air because of their euro peg.
Yeah, exactly. But remember also, and it gets by to the statistics you were giving on the Dow, what's going up. If you really look at it, if you look at the FANG, what they call the FANG stocks, and that's a double A in the FANG for both Amazon and Apple, that's almost a perfect fit, R-squared fit, to the growth of the balance sheets. And that reflects in, look what Swiss Bank are buying. You'll find they're buying the FANGs. So a lot of them are buying the indexes, which pushes it up. We have more and more passive investing through ETFs that somehow, whatever you do, go back to maybe 10 or 15 stocks that are really wholly driving the indexes to the degree that which these markets go up. And the statistic you said, and how the Dow's gone up, but what, in 5 days we went up here just recently 1,000 points on the Dow, and the previous 1,000 days took us 25 days.
Yep.
So
both records.
Both records on top of the numbers you were saying for the year.
And so margin debt for trader, to add to your point there, sorry to interrupt you, Gordon, to add to your point there too, margin debt too, because people have noticed this trend. Private investors are piling into this thing, and margin debt is also going parabolic.
And that is the word, it's parabolic. So we have effectively, you could say, a potential blow-off going. And the answer, you say, well, just a minute, Gordon, what's going to stop the blow-off? And all of this is based on credit, leverage, lending, and we're just so extended in leverage right now, gearing both at the corporations, the individuals, even investors. So what stops that? Well, you can borrow any amount of money, Jason, as long as you have collateral. Okay, some level of collateral. We get pretty skinny on what that collateral is. Well, we've run out of new collateral because collateral only comes from real profits that are coming out of real wealth creation or savings. And so if we don't have savings, or we're not creating real wealth, we run out of collateral. And the problem there is that the banks have something called rehypothecation, are pledging collateral the same item multiple times. That is perfectly legal if you're in an international environment where it's between countries and how you move assets across balance sheets and between banks, and it's been going on for quite some time. It's the whole basis of the euro-dollar system, frankly. But the point I'm getting to is where's the new collateral going to come to sustain that? So it's like trees don't grow to the sky. What makes it fall?
The other thing you just mentioned.
I'm not saying there's a crash coming. Just so our listeners don't jump to conclusions here, Jason, I'm saying that it's very, very tenuous. And the reason I say a crash isn't coming, don't ever underestimate what the government and central banks will do. Yeah. Legally or illegally, if I can use that.
Well, they could change the rules. So it could be illegal at the time. Then they just have their politicians or lobbyists or whoever rewrite the rules. And then, ex post facto, and boom, it's not illegal anymore.
Precisely. And you should expect that. And the secret now is to kind of guess what rules they're going to change, because you can be assured they will. So what will they change to keep this thing going? Because they have to keep it going. Because if things start to fall off, you know what a margin call is like, and with it over so extended, it could get out of control in a heartbeat. And I think right now 10% correction in the Dow would do it, which before was considered insignificant, really. So it's pretty difficult. So what will they do? And they will do something. And if you can anticipate that, that's where I think 2018 is going to be really important to you, because there's a lot of things that are coming at 2018. We have a whole de-dollarization that's happening globally for various reasons that we can get into if you want. We have something that the Bank of International Settlement was out, the BIS, a major report. I'm sure you read it, on what they call the big reversal and why that's going to happen. And I go on, but there's a lot of these things that are changing right now. They're not blatant on a daily basis, but they're slowly kind of chipping away as this glacier moves forward. And I think that the governments are going to run out of options here to keep this thing going. It may go out for another couple of years. You don't know.
And these central banks are essentially hedge funds now. With the Swiss National Bank, they're going in there and they're buying European private sector, European junk debt. Now European junk bonds have lower yields than U.S. Treasuries, which is ridiculous considering the probability of bankruptcy for junk debt.
Well, these junk bonds are going to be first of all, you have to understand the business cycle and the credit cycle are turning right now. We're long in this cycle. We're 8-9 years into it right now. And the credit and when the credit cycle really starts to break, you'll see it in the spreads and you'll see it in the junk bonds. And when you start to get inside the junk bonds, you don't have to look any farther than the ECB buying corporate debt. And they have bought so many, they got so much zombie debt in there. And look at Steinhoff going under here a while ago. And it was $150 billion right at Morgan Stanley and Citigroup, or whatever. I can think that they had to write off. We don't even know what ECB is sitting on. So when they start to have to do something with these bad debts, watch what's going to happen to the junk bond. And then that starts to cascade it, because now you're eroding underlying collateral on other loans.
And I think, Gordon, that the central banks, all of them, the People's Bank of China, the Federal Reserve, the European Central Bank, the Bank of Japan, let's not blame any one central bank more than the others. They're all to blame. They're all doing pretty much the same playbook. They're even probably coordinating things. Like you said, I've spoken with Nomi Prince. Her new book is coming out in a couple months. She told me at dinner that she thinks that they're literally coordinating everything daily. They're having long conference calls. She said that's how bad things are.
Without a question. That's a fact. I mean, it used to be that they met once a month, every 6 weeks in Basel, Switzerland, the major central banks. What are they doing? Just having supper together? Of course, they're talking about strategy and policy. They've done nothing devious. They're trying to do the best thing they can to keep the world system stable. But it's getting to the point that now the meetings are getting quicker, more frequent. They're having to coordinate things because one country, it's a global economy. We all know that. They can't work independently. They're tied. They're linked to each other.
And there's more debt in the system. And now the problems that were not solved in 2008, they were papered over with artificially cheap money and credit. And now the problems, as we were discussing before we started recording, Gordon, there's more problems. And now they're even larger in size. Like I think you said in your PowerPoint presentation for 2018 that you sent me in the slide deck. And if our listeners want a copy of that, they can email you or me. But you said there's 44 tipping points. I call them economic landmines. You could call them icebergs. There's a lot of different analogies, but there's now all these different problems that are $1 trillion in size or larger that were not really there in 2008.
Precisely. Just on these central banks coordinating, Jason, which they are, and I refer to them, one group is the currency cartel, where 95% of the currencies are in four currencies. That is the euro, the dollar, the sterling, and the yen. But and they're clearly coordinated. So, you to say who comes to that supper party, if you would, in Basel, Switzerland. Well, who doesn't come to it on a regular basis is the people that are in the Chinese bank, People's Bank of China. Russia's not involved to it. So I can start to go through things like the BRIC countries that are outside of it, who were the buyers of things like gold, whose central banks are really at odds right now with the other policies, but they're being forced because of the reserve requirements to work closely to hold the system up, with the exception of Russia, who's just getting beat down by U.S. sanctions, or at least attempting on the sanctions. So it's not like there's one big happy family that's working here, and some aren't even being invited to the Thanksgiving supper. So in there's going to be some major fractures because we're moving from a unilateral world to a multilateral world. That is, the United States trade is not that large anymore. China, the Asian bloc, is so large and such a huge amount of the global economy now that it has much more power financially. And as we see, the petrodollar and the euro dollar has been the basis, really the euro dollar, the basis of global debt. Well, now as we see the yuan starting to be able to be more of a viable currency, there's going to be, as I mentioned earlier, this de-dollarization, which is problematic. But flipping to your point, Jason, if you would, yeah, I've been doing tipping points or economic landmines for years now, and my list was 10 and 12 when I started. Then I got up to 20, and I thought, boy, this year it went to 4. We have 44 that we're tracking right now, and they're not little ones. It's like one of the China's hard landing, EU banking crisis, a geopolitical event, shrinking, a credit contraction. These are just items.
U.S.
Of
shale
the
oil bubble, Canadian housing market, Australian housing market. We could go up and down the list.
Jason, absolutely. We just call it housing market, period. And there's still 44. So the point here is that we have created this debt and this credit and this abuse of it, I'll call it monetary malpractice, for a sustained period of time, have created so many problems that the tipping point list that we're tracking is large, and any one of these can do exactly that, are a tipping point, and that in itself is telling. So instead of trying to identify which one, that's irrelevant. Just know that the system is unstable. The worst thing you can do is listen to the nightly news,
because it can set off a chain reaction. So if one thing that's big enough blows up, it'll set off a chain reaction of some of the others.
The good news on this, Jason, is this is crisis is change trying to happen. So we went to a globalized world, but we never put in institutions and governments and organizations and rules to make it work. And so it's kind of like a free roam. It's like the Wild West in many ways. And having been in corporate life, and back in the 70s and 80s, we used to call ourselves an international corporation, and we were learning how to operate internationally because we were finding our revenues were growing and starting to be more than 50%. So we had to get in and learn about the laws and how to operate, and few people could help us. Well, corporations did that, and did it really well and in a very sophisticated fashion. But governments never did that. They stay stovepipe working within their countries. And yeah, they have a little relationship where they try and get outside of, but the world is operating outside of their boundaries and outside of their control now, not just corporations. Good example, that's what's happening with cryptocurrencies. It isn't about cryptocurrencies. It isn't about blockchain and technologies. It's the fact that the network now is bigger and more powerful than the state. And governments can't control it. They're going to try. But the fact cryptocurrencies is just symptomatic of the kinds of things that we can do to change how we trade, how we govern, even how our sovereign states work together. And by the way, this paper that I just put out, I get in 100 pages into a lot of detail of some of the finest minds in the world who are working on this right now as we talk.
Before we talk about maybe your views on de-dollarization and the New World Order, I think the central banks have distorted so many of these different markets, with credit markets, with asset markets, the real economy so much, Gordon, that in the next 3 to 5 years, there could be a high probability of Dow 40,000, a market crash, or both. So then the question is the order of these things. Mm-hmm. And so, it's anyone's guess which ones would happen first.
Exactly. And by the way, you'll have both.
the average
and at the end of it, you'll be broke.
The average person, Gordon, that would be a nightmare to them.
A nightmare to professionals too. But that's the world we now live in. Because we've moved, the world of investing, Jason, I'm a little older here. The world of investing is long gone. Right now, we're now a world of what we used to refer to as not speculation, as wild-ass gambling. because when it used to be that when you did investing, you could work to three decimal places what you thought the returns were going to be and what your risk was. Today, it's like spin it and here's the probabilities, and the probabilities are changing. So we really moved to a completely speculative world because the truth of the matter, there's so many moving parts in the macro world. It used to be within one country, the Fed controlled the money supply. We had a little bit of a shadow banking system, but there was some level of structure and order. Today, the currencies, the interest rates, everything, every country can impact another country and movements of trade. It's almost impossible to figure out how it's going to play out until it gets to an extreme. And when it gets to an extreme that's off all ends of the charts, too high or too low, it tells you that there's going to be some reversal to the mean, regression to the mean, globally to keep, or it breaks, and then you've got another. If it's not a contiguous algorithm, and so that's the game that we're in. So when we get to the extremes, and we're getting to all sorts of extremes right now, that we've got some kind of regression to the mean coming.
I agree, and one of those main regression mean themes that I think is going to happen in 2018 is I think we're almost definitely going to have more asset price volatility because there's been so little of it for so long. But you think, Gordon, that in 2008...
Yes, by the way. The VIX is going to be a big story in, if I can use that as a measurement of volatility. But the VIX is going to be a big story in 2018 because of the degree, and I talked briefly earlier about this, the degree of which it's being shorted right now. Everybody in the world is on taking the VIX down. The levels are down at 10, 12 are unheard of. And what it's done is it's underpriced the puts. So the call prices are very, very high, but the puts themselves, because they're shorting them, the puts themselves are dirt cheap. So all of a sudden, when this move moves, the derivatives and the opportunity to make some money is going to be dramatic and very, very quick. And also, Jason, ETFs have become such a dominant part of the market. I'm not picking on ETFs, but I am saying the beauty of an ETF is your ability to exit very quickly. A keystroke and you're out of it. But is there enough liquidity to get out of it? And a huge amount of the ETFs have been in the bond market. And the banks no longer are making market in bonds. They've moved out of those, shut down a lot of those desks, at least to a larger degree. So when everybody starts saying, well, I'm going to move out of bonds, remember in 2008 it was a matter of the chief financial officers saying, I think when the federal fund rate broke the buck, the Fed funds as a money market broke the buck, all the CFOs said, well, I think I'll move my money to treasuries, $5 trillion. And suddenly we had Paulson and Bernanke going up the hill and said, the world is on the verge of coming over, just simple keystrokes of going to better secure money from asset-backed commercial paper, for example. Right now, some kind of worry in the bond market, junk bonds or whatever, and we start to see people saying, I'm going to sell my bond ETF, whichever one it is, there's no liquidity. You'll have custodial risk. It could be a contagion and counterparty risk like we've never seen. I'm not saying that's going to happen, but I am saying we're at the end of the credit cycle and the business cycle, and unless we've completely stopped the credit and business cycle, and I don't believe we've stopped it, then you're going to have that kind of problem beginning to loom. Now, the government's going to react to that. The question is how.
Well,
will they start buying bonds? Well, they've already bought the entire inventory, it seems. But yeah. They're done. They can't. That's the problem in ECB. They got no more bonds to buy. So they're going to start buying equities, right?
Or nationalize the banks, maybe.
I did a paper a while ago that we're effectively right now nationalizing the financial markets without saying it. That is, we've completely taken control of the bond market, and we'll soon start taking control of the equity markets. We have, and the banks themselves. By the way, we've organized the Basel Agreement on capital ratios, and the incentive they have to put on their books repos and sovereign debt. We've effectively nationalized them, or they can't grow.
Is this a global debt for equity swap like what Catherine Austin Fitts has talked about for years, how Japan has basically monetized almost all of their government bond market. They can essentially almost do a debt jubilee. They've even discussed this, doing it in the future, and they've been buying stocks and trying to get people into stocks. Is this like a global scale attempt at a debt for equity swap while they're claiming that they're going to take away liquidity in 2018?
Precisely. Catherine was way ahead of her time. She's been right for 4 or 5 years that I've been talking to her on this, and it comes from her background on Wall Street. She to her it's just obvious. Now whether it's that controlled and that structured and that planned, it's more just the evolution of how to make money. And as bad as Japan looks on the surface, and everybody I talk to says, oh, their debt is out of control, blah, blah, their interest rates are 20, 25 years, but actually they're smart as foxes in what they're doing because the debt's all internal debt. If you actually look at what they're doing per capita, it's growing in a positive fashion. And they don't have the risk. You start to see bond markets get into trouble. They pull back their money back to Japan because the Japanese carry trade's been the underlying money printer around the world here for 20, 25 years. So don't underestimate the Japanese strategy. I'm not saying the leadership, but what their central bank's doing, as absurd and obscene as it looks like on the surface. The central bank that worries me the most, Jason, just to switch gears a little bit, is actually the People's Bank of China.
I was actually going to bring that up because a lot of the community, Macro Voices podcast did a great 5-part series on the end of the dollar, talk about de-dollarization, plans for that. The thing is, I don't think it's going to happen anytime soon because one of the main leaders of that is China, and now China is in bad shape. Maybe 5 to 7 years ago, China was in better shape, but China got greedy. They created a huge credit bubble internally in their own country. On top of that, now there's 1.7 trillion external debt. China has huge problems financially as well. So they were in better shape before they allowed this credit bubble to explode.
China's caught in a tough situation. They're going to try and, as much as people think they're going to drive de-dollarization, they're going to try and stop it. Because if you look at China's GDP, yes, they have massive exports, but they have massive imports also. And that's where they make their money, is really just cheap labor and the investment that's come into it. But if you look at it, 44% of their GDP is foreign direct investment. That's money that's been flowing in to China for since the World Trade Organization entry. So that's a big part of their economy. Well, that money is not flowing in, it's flowing out. It's been leaving. So they have the highest interest rates of the major countries. We're talking about the U.S. 10-year bond being 2.61, and then we work down all the way to Germany at 0.6. Well, China's is north of 4% right now. How are they doing 4%? Because they're keeping it up so that they can bring money into the country. They've got to attract, maybe not investments for factories, but they have got to bring money into the country. The way you do that is not to make your currency cheap. Okay? You got to keep your currency stable, because you don't want to invest in something and find out you've lost half your money on a currency devaluation, right?
Yes, and this is a balancing act,
precisely,
what you said, because if you talk to experts, you talk to a lot of economists who have looked at China, you talk to hedge fund managers who are very astute like Kyle Bass, they will tell you, based on their research with absolute certainty, that it is a question of when and not if China will have to do another massive currency devaluation. Now, Kyle Bass has been wrong for 2 years on the timing of that trade, but they will probably have to do a 20% currency devaluation, maybe even larger than that, to start bailing out their banks. They have a huge non-performing loan problem there. And, a lot of their state-owned enterprises in China have massively overborrowed in dollars.
Yeah, you're right on the devaluation, but they got to do it right now after their new state assembly or our Congress that they just had here in October, where they got another 5 years, because they do need to bring it down, but they can't right now. They've got to bring this capital in, and that's one of the reasons that, in my opinion, Bitcoin has went crazy. It's not just the speculation. It's money in China trying to get out. And they have found that the way they can get around the limiting capital requirements is using Bitcoin as one of the vehicles of which they can do it.
Exactly.
And so I'm not saying it's the total reason, but I'm saying do not underestimate the power of what's going on to move it there. So China's China's central bank's on the verge of losing control. I don't think its numbers are valid. I'm not saying it's it's bad or devious. It's just that it's evolving. I mean, this is a massive build out that nobody in the world has ever undertaken in such a period of time. And how do you control it? And they just don't have the infrastructure that kind of manages things. And capitalism is no stronger anywhere in the world than in China. The entrepreneurs and the billionaires that are being made there, and the deviousness of which they'll figure out how to make money. It reminds me of probably the 1920s in America. It's a wonderful time, but they know the smart money in China is scared, and they're trying to get it out.
The problem, Gordon, in China is that this really isn't capitalism. A lot of this is Keynesian central planning with the amount of money and credit injected into the system that, they're going to build this one belt, one road policy. They're going to build bridges through, these small Eastern Asian countries and towns where there's no population. They're moving a lot of different adult Chinese males to do the construction projects. They're giving them jobs where maybe they would have been unemployed and potentially create a political revolution. So they're getting more of the angry ones out of the country with a job. I think that could be part of the reason why they're doing some of these additional construction programs as well.
Chase, I fully agree with your comments, but you're coming at it from the government and central planning. Absolutely correct in what's going on. My comment is coming from the individuals trying to rise up. And the businesses that they're creating and the schemes that they'll come up with to make money. And
there's a lot of
entrepreneurs to get their money. Oh, there's a lot of
entrepreneurs in China.
That's simply what I'm referring to. I see it firsthand.
Supposedly, Apple sales are down a lot in China. In fact, there's higher quality smartphones now available than the iPhone in China at half the price. So that's why Apple's not in the next couple quarters. Supposedly, Apple's going to miss because their China sales are down a lot.
Mm-hmm.
Well, what's your opinion then on de-dollarization? So a lot of people, and I think this is a huge mistake in the gold community, basically there's like gold pumpers and there's a lot of these press releases that come out with certain websites, certain YouTube channels that, it's going to happen every couple months. They claim it's going to happen. But here we are 10 years later, basically after the global financial crisis, and there's still not a lot of the steps in place to totally get rid of the dollar and crash the dollar yet. So this
it's in nobody's interest anywhere in the world to crash the dollar. To bring it down. You'd think maybe China, but it's not in anybody's interest. Everybody wants the dollar to be the stabilizing force. The reality is the dollar itself no longer can fulfill that role. And so that in itself is the issue, and it's because of what's underpinned the dollar's growth. Think of it this way. The dollar itself is standard. It became the standard. It wasn't just the Bretton Woods, and it was the era after the Second World War, where trade around the world was from American manufacturing facilities into countries, and they had to buy those goods with American dollars. So the dollar itself replaced the sterling, but became the standard de facto around the world because that's what they were buying was American goods. Well, by the end of the Vietnam War, or as we went into the Vietnam War and Johnson's Great Society, and we were starting to live beyond our means. We were consuming more than we produce as a country. We were financing our wars on a credit card. Things began to change in America. But to get around that, as you well know, in August 1971, we went off the gold standard. But what we did to move from there wasn't just that we went to a fiat currency. We started the petrodollar. And that was oil in the world could only be bought and sold in U.S. dollars. That's the agreement we struck with Saudi Arabia, and we've lived with it. And the people that have objected to it, like Saddam Hussein or Gaddafi, have been duly replaced. But now that's changing. Now we're starting to see massive amounts of oil being transacted between Russia and China and Iran and other areas not in the dollars. There's no longer the requirements for the dollars as much. It's rounding off. But that's not the key point. The key point is after that, we got in the 80s, 90s, we started to, with globalization exploding and our balance of trade becoming so much negative, our debt was going, because we used to settle up until 1980, we used to settle international payments, balance of trade at the end of the year in gold. You had to credit your account in gold or move the gold physically, even though it was a ledger on the New York Reserve, between countries. We didn't settle in credit. We settled in gold. Well, the reason the bond market started to fall after Volcker's period is we started to settle in credit so that we could say, okay, I owe you so much money. So our balance of payments was getting larger, which allowed countries like Japan, who were getting a lot of that money, who very quickly figured out how to buy U.S. Treasury bonds with the money. Don't hold on to it. It's a hot potato. Get it back into America. Buy the bonds. Drove the interest rates down. Drove the price of the bonds up. Banks had more collateral. People could buy more. Houses went up. And as long as you kept and debased your currency in Japan, and the mercantile strategy took over. What that led to, and I just don't mean to give a history lesson here, but it's important to understand that, is suddenly all the banks started working using dollars on their ledgers. So suddenly, if you bought repos and other kinds of items, you could make it an asset, not on your liability side, on your asset side. And you could move assets between countries. And that's why the swaps marketplace, $400 trillion, well, 650, but 400 trillion in bonds took off, because you could take one bond in one country with one country or with one corporation, swap it for another, and how it went on the books allowed you to create more asset as the bank doing the transaction, or more collateral. But that's now starting to change too, because the issue, and I alluded to it earlier, is there's a shortage of collateral now, Jason. So all of these little stages are suddenly undermining the U.S. dollar. And where's the fix? How can they keep this thing going? It isn't that anybody wants to de-dollarize. It's just that suddenly they can't keep the assets going, or the growth of the assets, because the debt is predominantly denominated in U.S. dollars. And as you well know, in the emerging markets, they borrowed, for example, I'm just using an example, $9.5 trillion over the last 6 or 7 years, all denominated in U.S. dollars. Well, if their economy's not growing and they've got inflation and their currencies are debased, how do they get those U.S. dollars to pay them back? Their debt, exactly. So this is an example where the debt is crippling, and they can't borrow anymore because they need collateral.
It's on a much larger scale than what happened during the Asian tiger crisis and the tequila crisis. So it's similar in terms of, they had overborrowed. The private sector, emerging markets, private sector companies, and emerging market governments had overborrowed in dollars, and the banks, needed to be made whole. Back then, when those bailouts started, they were a lot smaller, but things have gone exponential in the last couple decades for that.
Precisely. 2008 was fundamentally a U.S. problem, banking. It took hurt the world, but we could fix it. The Asian crisis was a little larger, but it were small countries that are impacted, from Thailand, and they all felt it, but it was a little bit more regional. We're now, the next crisis, and it's global, and it's not just the equity markets, it's the credit markets, it's the bond markets, more important, and it's going to be the currency markets. Well, this is a whole, and because it's not to preach doom or gloom, the complexities of this, to fix it, are not a matter of a central bank taking certain actions. Because the core structure, how we've undermined it, that's why I went through, for example, the Eurodollar system, is flawed. It's fundamentally flawed.
So I would disagree with you a little bit about 2008, that it was just U.S. I would say that the global banking system was so interconnected that there was a lot of banks affected. So there was definitely European banks that were not actually recapitalized well by the European Central Bank at the time and by governments. And instead what happened was, we know this now from the Ron Paul one-time partial audit of the Federal Reserve that came a couple years, I believe, after the 2008 financial crisis, right before Ron Paul left Congress, that over 16 trillion, might have been over 19 trillion, was given out in interest-free loans with currency swaps to foreign governments, foreign central banks, foreign corporations, large American multinational corporations that had overborrowed.
Yeah,
So some of that money has been paid back, but that was a global crisis. People said it was just the U.S. housing market and just the U.S. banks, but it was actually, it was so interconnected, especially the financial system. The other thing was if China had done this,
Jason, you're absolutely correct.
Yeah.
I'm just trying to be simplistic here and trying to describe it and how it was perceived. Oh no. You don't ever think that it was just simply the U.S. buy mortgage-backed security markets. Who was buying those mortgage-backed securities and how they're being financed? Now we're talking international banks. There are no more. The borders have been gone since the 90s, effectively. If you want to talk finance, so any comments we make and I refer to a country, it's almost figurative.
Well, yeah, George Soros has wanted the borders gone for a bunch of nefarious reasons, but I'm not sure if we want to talk about that during this podcast. So with his open society garbage, he's basically destroyed cultures and, created huge welfare states. But anyway, though, if China hadn't done their stimulus program, Gordon, during the 2008 financial crisis, China probably already would have collapsed too with civil unrest, and emerging markets probably would have been in even worse shape as well.
And so would the rest of the world. Because China had to create and pump that amount of credit that spilled out around the rest of the world. We had to do it. It wasn't going to be solely them, but the degree of which they did it, not only you could see it in the emerging market, but it was right around the world. So maybe they overdid it. But remember what's happened now with all of this money pushing that we put out. We have massive supply now. We very seldom talk about that, Jason. What all this money printing does is it brings future demand forward. And so we've brought demand forward, if you can use that. But that's not the issue. What we did, cheap money has created. So you travel around the world, it's unbelievable the amount of production capabilities that we have put out there globally outside of the developed world. Now, having said that, what that means is they're all expecting growth to pay in emerging markets to pay back their debt, but the growth isn't there. They don't have the pricing power anymore. That's called deflation, by the way, when you start to lose your pricing power.
And if the dollar gets stronger, so what you brought up with they overborrowed in U.S. dollar, so if there is another financial crisis and the U.S. dollar gets temporarily stronger, a lot stronger, that would bankrupt then foreign corporations who had overborrowed in dollars and also emerging market governments who have overborrowed in dollars.
Now we get back to what Catherine has said. Well, during the Depression, the banks foreclosed on everybody's farms. So when things go bad, the banks come in and grab the collateral. So when these zombie corporate companies in a lot of these countries around the world that overbuilt with borrowed money from the banks come in and seize the assets, that's when it's going to be a debt for equity. And there's going to be it's going to be like a quasi Great Depression in terms of the banks scavenging a lot of these places. And maybe it's not banks per se; it's elements of the shadow banking and the hedge funds and everything else that are operating here. But you can see it being set up, whether it's planned or not, for this sort of thing to occur, because the supply it's just too massive. So where is the new productive assets that I talked about earlier that are invested to create savings vis-a-vis profit that will underpin the debt infrastructure and the collateral and bring in the new money to pay the debt? I go through this all the time, with people, Jason. Right now, the global economy, we have 220 trillion debt. Well, so what's the average interest rate on that debt? Well, let's say it's 4% for, on average. A lot of it's been cheaper since, but that's what. So what are we talking? We're talking $8.2 trillion of FIG, if the mafia call it, the day that's got to be paid out. Well, the global economy is only 72 trillion. So what's the global economy growing at right now? 2%? Hell, let's round it up and say it's 3%. 3%.
I'm sure it's overestimated. Yeah.
Of course. I've done a whole paper last year on the illusion of growth to show the GDP. It's actually negative and it's shrinking. But anyway, that's another discussion. So I'm going to give them and say it's 2 or 3%. 3%. Make it 3% of 70. 2.1 trillion. 2.1 trillion from 8 trillion. Guess what? Got $6 trillion shortfall. So now you can't really use GDP quite that way, but it's close enough to tell you we're not producing enough new value to pay the existing debt. And right now, if you look at the shortfall I just calculated, and you use $250 billion a month times 12 months, it comes out for the delta. That's why the money printing is being pumped in here to keep the collateral values up. Now, do we think the economy is going to go to 4%, 5% globally because of Trump's tax reductions? But by the way, are not reducing costs. They're just buying more debt to finance them potentially. But is the growth there? I don't see that growth.
Well, they can make the GDP look almost any way they want.
Exactly.
So they can change the formula. They can do that. They can knock out the real inflation rate. They're not actually producing a lot of real wealth, though. The economy, when you look at the real jobs numbers, it's not creating a lot of high-paying full-time jobs. It's creating a lot of part-time jobs still.
Well, it's happening too in the GDP formula. The governments are now, it's all double accounting. All the welfare payments and transfer payments are so massive and so large that's then accounted as consumption, and the money's all borrowed. So the money for investment is borrowed, the money for government's borrowed, and the money for the consumption is all borrowed. So where's all the money coming from? Exports minus import. The GDP formula is so archaic and it's so illogical right now that it's almost sinful to use it as a description of the economy. But then that's a whole discussion.
I completely agree, but that's what allows the governments to keep borrowing without their currency and their bond market collapsing.
Oh yeah,
so they're in this perpetual motion machine game of faking the economic data, faking the GDP, faking the jobs numbers, faking the real inflation rate. So things are going to get even more divorced from reality. These Trump tax cuts, I'm obviously libertarian. I'm in favor of tax cuts on the private sector, income tax, lower income tax, lower corporate taxes. The problem is the government did not cut spending.
Right, exactly.
So you have
congratulations, Jason. You're the first one that really gets it. Tax cuts are great, but you've got to cut the spending or they don't work.
Well, it means stagflation in the long term. It means guaranteed stagflation then, and it means, I think, we've heard the central bank talk about raising interest rates, especially from the Federal Reserve. But, you've been covering financial repression, so you can answer this better than me. Is this just all talk? Is this a head fake then? They're going to lie about raising interest rates? Because it would seem to me if the debt's going to grow like that, they would need lower interest rates, because isn't that what the U.S. federal government has done for the last 15 years, where the amount of debt has actually exploded, but their interest payments are the same or lower than 10 or 15 years ago because the interest rates have been manipulated down?
I would really like to tell you that they're that smart and unfortunately that devious, and that they have a plan and a strategy. But I have concluded at the end of all of this that actually they're that stupid, that disorganized, because there's just too many people involved in it. And so they really think in the United States that we're going to normalize the balance sheet. I believe that Drahi actually may think that he's going to start a taper program and winding it down. They believe that. It isn't going to happen. Can't happen without a massive depression that the people will not for 1 second tolerate. So what's going to happen?
Bankers are jumping ships. I think Draghi will be gone in the next year or so.
That's what happens, how you get out from. So you bring in new players, and then you pass the blame on previously. But I would suggest to you, as we roll into the summer, and you may want to play this back, as we and into Q3, that we will be starting to worry about trade, recession, new words, tightening in the credit markets, went too far too fast, and they're now backing off, normalization, backing off in the ECB, and we're back to printing more money. They may not call it QE4, but we are going to continue, and we have to accelerate the rate of the central bank's balance sheet growth. So really the tax plan was a form of the way we did it of helicopter money. We basically handing money to citizens. I know it's their money, but the only way a tax plan reduction works is you have to reduce the expenses of the government. We didn't do that. So we're financing it with more debt. It's more Keynesian financing. And the theory is, well, the economy is going to grow. It can't grow anywhere near the amount of debt. Now, it's
an attempt at the supply side economics, which is not Austrian school either. That's just a different version of central planning. So rather than Keynesian stimulate demand, they're trying to do supply side economics right now again.
The stimulus doesn't work anymore. It used to be, when you study that, for every dollar that the government put into stimulus, you get $4 or $5 back, $6. Well, Lacey Hunt, who at Hosington Group does, he worked in the Fed, one of the most brilliant bond minds that I've talked to, he just almost laughs at this. It's a joke. He says these numbers now are negative. they actually take away. He says there's a chance that the stimulus will grow economy, but it can't under this environment because and I don't want to paraphrase him, but the debt is too large to control it. So he actually sees yields and interest rates going down because the velocity of money continues to fall in the country or globally. I'm being a little short on that, but it's the tax plans is just another form of helicopter money of trying to get it out there. Unfortunately, it's not going to the right people.
Well, if the money actually did go into the economy and it resulted in higher wages and there was actually real investment in the economy, new products and services, new businesses, wage growth, then that would be the demand pull inflation. So that would be inflationary. But I think, there's been many trillions of misallocation of capital all over the globe. So I think governments are underreporting stagflation, but we'll have to see what happens. We could have, 2008 event again or worse in the near future where temporarily there's a deflationary event, but there's really nothing to stop, like you said, the central banks or the governments from just changing the rules and saying, okay, we're gonna do a debt jubilee, or we're gonna bail out the banks, we're gonna change the accounting laws for this industry or that industry, we're gonna tax the gold holders or the Bitcoin holders are going to get a windfall profits tax. Unfortunately, this is the world we live in. There's nothing fair about this, by the way, either. This is just the world we're living in right now.
Exactly. By the way, I want to make sure none of our listeners believe that I don't believe in tax cuts, because I do. But I want the tax cuts to go to the right people, and I want the government to reduce its expenses to offset it, so we don't have to have these magical GDP numbers to make it happen.
Yeah,
because, by the way, you can't. And there's another issue. I don't know. Did anybody ever take an economics course that's in public office? You don't do this at the end of a business expansion cycle. We're 9 years into this. This is not the time you do this.
Politicians don't think about the long term either. It's just about the short term. So Donald Trump.
So he may be right, but he shouldn't be doing it right now in this format. And I'll say in 2 or 3 years from now we're going to know this in spades. But we'll be in the middle of another crisis and nobody will pay attention to it because of all the things we just spent time talking about.
So gold then. I obviously like gold. I've been covering gold on my channel for many, many years. It's had a really bad paper bear market since 2011. 2017, it had a quiet restart maybe of the bull market, around 13% move. Do you think then that ultimately that gold has basically bottomed? It may go sideways or a little bit lower, but it's going to start going a lot higher. It's starting to sniff out that it's being lied to, that the politicians and central bankers are basically lying that they can magically reduce their balance sheet, magically raise interest rates, and not have market crashes or recessions or anything with government economic data.
Well, the problem with the gold and silver market, there's no question that it's a manipulated market, the paper market. Okay, they're going to do everything they can to make sure that it doesn't rise up, but then you've got other places buying it, such as have been, at least were, China and Russia, and I believe they're continuing to build their reserves. But we're seeing movements now in the junior miners, and a lot of these that have been dead are starting to really pick up steam. So that's a sign that at least people are starting to believe that's going to unfold. I'm really cautious. I believe everybody should have gold and silver in their portfolio to some degree as an insurance policy. But be really careful because, and I've said this for a long time, one, the government's going to come after it in some way and tax the hell out of it if you do get it does go up and they do lose control of it. But before that, they're going to continue to manipulate it. The point isn't so much gold and silver. The point is to be in hard assets, in things that can't be reproduced. There have been a lot of commodities, hard assets, that have exploded. Cobalt, lithium, because the electric volt car movement, not so much in North America, but what they see coming in China, et cetera, has exploded. Absolutely. I mean, you want to know what a chart that looks like it's going vertical on some of these commodity prices. So if you can pick the right one, some of these hard assets, I can see more movements in there.
I'm not as bullish on a lot of the base metals because I think, China is going to have a hard landing at some point. And China pulled, in my humble opinion, I think China pulled at least 4 decades of demand for a lot of the industrial metals and cement and things like that. They pulled that forward over the last 15 or 20 years. They pulled, I've seen estimates where they pulled more than 70 years of demand forward in the last 10 or 15 years.
I don't trust the whole futures market associated with the games that have been played there. and the manipulations, and then using it to pledge for various collateral. I think it's just a can of worms. I think it'll make Enron look like a saint.
Well, I know the futures markets are manipulated. No, gold and silver is heavily manipulated by the paper markets. I'm just saying the actual demand for the real industrial metals, China, it was not sustainable for them to continue to build, all those cities, all the infrastructure with copper, all the cement. They can't do that indefinitely. So they pulled, many decades worth of demand forward into only about a 15-year time frame. So there's a lot of demand projections for a lot of the industrial metals and others that have China demand levels, not falling off a cliff compared to what they were the last 10 or 15 years. And I'm saying, it's not sustainable for them to have those levels of demand. I would not be shocked, let me put it this way, if 5 or 10 years from now, if the demand China had for those industrial metals was cut in half.
As you know,
and China basically is a lot of those markets.
Yeah, Jays, I'm with you on that. You got to be very, very selective. I'm a lot more aggressive personally on soft commodities, foodstuffs.
Yes.
And specific areas within foodstuffs, because you got to grow it.
And people are eating more protein and more calories. So,
right.
That's a long-term trend. People in China, I believe I just read this, finished this audiobook about China, about one of their historic roads. And I believe the average person in China, like emerging middle class or poor person, only had meat once a month. And now they have it quite a few days a week.
Exactly.
So, their standard of living is what someone in the West like you and me, we would take for granted when we go out to lunch or dinner or go to the grocery store. People in China are actually getting more of the things that we take for granted.
I see what the price of tuna goes for around here in New England, and it's all being shipped to Asia for sushi, etc. And there's the demand is and what the people are willing to pay. And as you get shortages and you get a bigger demand, because the demand is growing, 7.6 billion people, as you say, are now deciding they can live better, and there's a money in all these emerging markets and frontier markets. There's only so much foodstuffs that can be grown or produced. And we've already got it maxed out in terms of equipment that we put in the farms, even our livestock, how we're force feeding it, et cetera. There's a massive issue coming with foodstuffs and that element of the commodities. I'm not saying it's here quite yet. But it's one of those areas
it's a long-term trend. Yeah, you can't. The short term is tough to predict, but I agree with you totally on the long term.
Exactly.
But for the gold and silver markets, Gordon, not sure how familiar you are with the business model, but actually the more manipulation there is in the paper gold and silver markets, the more the 5 largest precious metal royalty and streaming companies actually benefit, because they have good balance sheets, they have low cost cash flow, highest margins, they have easy access to capital, and so the regular gold and silver miners or a copper miner with a lot of gold or silver byproduct, when they get in financial trouble, there's not as much equity available to them from banks or shareholders, and also there's not as much debt available, so they're going to the royalty and streaming companies to sell, large chunks of these really high quality streams off for gold or silver. And that part of the business model, the more manipulation there is, the longer gold and silver is kept down, the more these, the Franco-Nevadas, the Royal Golds, the Wheaton Precious Metals, the Cisco Gold Royalties, the Sandstorm Golds, there's even more entrants entering the space now. There's a bunch of new companies forming. The more those guys are going to benefit. And Gordon, you mentioned the tax component about a windfall profits tax. They've already thought of this. A lot of these companies, they may be listed on an American exchange or Canadian exchange, but they're headquartered out of the Caribbean where they pay no taxes. They've already structured that to defeat the tax ban.
It's tough to lose money investing in a product, even if it's manipulated, when the price is selling for what it costs to extract it from the ground. Gold, it costs them nearly what gold is going for right now to extract it, and you make a profit. And so if there's any kind of demand, it says its price has got to go up and go up dramatically. And we've been at that point, so you can only manipulate it so long.
Agreed, and eventually it'll kill the miners. So they can manipulate it, but they can't knock silver back down to $10 or lower, because there really is very few primary silver mines or even silver byproduct available on the planet that can be economically mined at that price. And the same goes for $600 gold. I've seen deflationists out there saying gold every month or two goes out all over the internet in his newsletter blast. The guy's making millions of dollars a year. Says gold will be below $700 an ounce in the next month or two. And he's been saying this like a broken record now for 4 or 5 years. Just ridiculous stuff. And he doesn't look at any of the mine supply. You know, all the miners would go bankrupt, and there wouldn't be any new supply available.
Mm-hmm. Well, I don't mean to poo-poo gold and silver in any way, Jason, because I've been a long-term holder of it, and I always have been. I've been a strong believer in it. But when it goes, and it will go at some point, you will miss it. It'll just be boom. It'll be some kind of crisis, some kind of event, and before you can even move and be filled, you'll be stunned at what the price will be.
Yes, but the thing is, I'm not sure if you can call, physical gold and silver an investment, though. So I think it's more of an insurance policy.
It's not. It's an insurance policy. It's not an investment. It's dead money. You're not making any real return on your investment per se. It's the appreciation. No, it's just an insurance policy. That's how I've always looked at it. As a certain percentage of my portfolio should have an insurance policy, and I look at not just gold and silver, got palladium and other metals that are precious in there that you can use, and of course I also include colored diamonds in there too. It's just as an aside, but these kinds of elements as insurance within a portfolio.
Yeah, I agree. The investments are the royalty and streaming companies, like I said, because if the manipulation, gold it had a basically textbook bullish inverse head and shoulders chart pattern, probably should be over 1350, almost 1400 now already. It was knocked back down yesterday to 1329 to consolidate for a little longer with manipulation. A ridiculous amount of paper futures contracts came in and bombed the gold and silver price again. If the price doesn't break out and go higher, the royalty and streaming companies are just going to do more deals for cash flow because the miners don't have access to the capital. So I think, they have basically a bulletproof manipulation. They actually benefit from the manipulation, and they grow their business that way. They make more money, more long-term cash flow at a lower cost that way.
We were looking at Bitcoin at Financial Repression Authority as an alternative to the banking system when hardly anybody was talking about it, and we were doing all sorts of videos and interviewing people as it was emerging. But when Bitcoin was equal to an ounce of gold at around $1,300 an ounce, I remember at that point in time I saying, it can't possibly be worth more than the price of gold. Well, clearly I was totally wrong when I saw it trading here a few weeks back at 20,000. But it's not so much that I was wrong, which I was, but maybe the gold is now so seriously underpriced as an alternative right now that it could quite easily suddenly, and silver be trading at $6,000 and $8,000 just as fast as Bitcoin went up or the cryptocurrencies moved around. We don't know, and that's this whole speculation and gambling environment. And
both things are true. Both things are true. That you were briefly wrong temporarily, but that gold will go up. But the other thing, Gordon, is with cryptocurrency, I think, a lot of people don't understand that there's a huge tech bias. So, there's huge cryptocurrency demand in Asia. They have very high STEM backgrounds. And so they played a lot of video games and they bought things inside the video games. And here in the United States, in New York, in Silicon Valley, huge tech bias. People love technology. So things that have technology components get a higher valuation. It's sexy, it's sleek, compared to, something like gold.
I read an outstanding article on the Wall Street Journal talking about the millennial generation, and though they don't mention, there's 73 million millennials, almost as big as the baby boomers, that are now under the age of 33, that have got student loans. Their asset values are much level than previous generations. They can't get the jobs, never mind paying back their student loans, and so the world of robo investing, but the world of speculating. And the article in the Wall Street Journal was talking about the millennial generation, where they're falling in love with cryptocurrencies because they're seeing a fortune to be made where they're making more money on speculating than they could ever hope to make in the kinds of jobs that they had. And this is not the odd person. This is a huge amount trying to raise themselves up from the state that they're in. And as you just correctly point out, they're more network oriented, they're more computer oriented. This just resonates with them as a logical step, and it is a logical step. And so they're also driving it. It isn't just China, it isn't just the fundamental underpinnings, but the speculation from this generation appears to be, at least according to the Wall Street Journal and other sources. And by the way, the amount of emails I get from people of that generation asking me what my opinion is because of Financial Repression Authority is also very telling. So I think you're onto something there, Jason.
And unfortunately, Gordon, a lot of people are also buying cryptocurrencies on credit cards, and
I heard
they can
that.
actually pay it back. So
I couldn't believe that, but it's true.
Yeah, I think 20% of all cryptocurrency purchases in the last 6 months were in credit cards. So I have some friends who did it, but they could pay back the money. But I'm worried that a lot of people who can't pay back the money did it, and they're hoping that the cryptocurrency price would go up. They'd make a lot of money, they could sell it, and then pay back their debts and pocket a profit off the difference. But
I guess
it's a dangerous game.
I'm older than you, and I can just put different names and different tags and different rationale. But borrowing money to invest in the stock market, I saw it the same thing pre-87, pre-2000, pre-2007. I've seen it so many times. And when you see people going out and borrowing money to put it into these kinds of speculations without being able to show you the true spreadsheet underneath it, we're closer to a top. It couldn't go on. It always goes on. At top, it always goes on longer than you think, because people finally say, I can't afford to be out of this, and they just say, I got to be in, and that's when it starts to crack. But this is almost a classic textbook example.
Well, we're in the everything bubble, right? So basically everything but gold and silver, there's an argument that every asset class but gold and silver is in a bubble, and there's also an argument, I think, that basically there's hyperinflation in the asset markets.
I call it the Minsky moment, but that's what's going on right now. We're clearly in the part of a Minsky melt-up right now. That's a pretty strong word, but I think I think there'll be some corrections, and I've mentioned earlier scares, but I still think we have more to run because of the comments I made on the banks and the government and changing the rules, and because they can't afford not to. So, don't get scared. But it's a game of steel. You got to have steel nerves, or you've got to decide where everybody's looking is not where you want to look, and you want to look somewhere else.
The other component, Gordon, about that adds to what you just said that we didn't touch on earlier, and we touched on so many very interesting topics. Hopefully our listeners love this discussion. The one other point I would add is government tax revenues. So if one of the major points why the central banks, especially the Federal Reserve, intervened during the 2008 financial crisis, and they called it the wealth effect, but it's really BS. They named all the positive reasons why the wealth effect was good. The number one reason why they intervened was there was a huge drop, I think like almost 20% drop in U.S. government tax receipts because asset prices had fallen. And so that's a big, big no-no. They're not going to let the tax receipts, because we're already seeing a decline, I think, right now, despite, these GDP numbers of Trump claiming how good the economy is doing. There's already, I think, a fall-off in tax receipts, right?
Yes.
So which are a far more, let's say, realistic indicator of how the economy is doing. And so if there was an asset crash, a huge crash in assets, and it was prolonged and it lasted a long time, that would be a huge drop in tax receipts for government.
Yeah, if you look at all the state and federal tax receipts, they've been steadily going down at dramatic rates, really before the tax cuts, which are going to hit it big time this year. And that means how are we going to fund those, which means more supply going out into the market. And where's the money going to come for it in the short term to pay for it? But you're right on, Jason. It's a huge amount of money, the shortfall that we're seeing already in tax incomes. And they can't agree on a budget that itself is flaky against the revenue streams.
And cryptocurrencies, I think, one of the main reasons that governments haven't fully tried to kill it is because there's a lot of new tax revenues that are going to be paid from it. So I think governments at this point, they would rather tax and regulate it so they can have a whole new revenue stream of positive asset price taxes on cryptocurrency. And then, maybe they can, and I've been discussing this, you could talk about this with your NWO, maybe you talk about that in there. I haven't read your paper on that yet. But I think, governments are going to look at taking the technology behind Bitcoin blockchain technology and having a government-issued cryptocurrency. And, it's not decentralized. You're not doing it voluntarily. It's where governments are forcing you out of cash, out of gold, out of Bitcoin into a government cryptocurrency. Basically, it's the worst Orwellian wet dream, of, totalitarian control, where everything, cash, gold, all these other options are banned. It's a full legal tender law. And so if you speak out, you criticize the government, they can take away your bank account. They can, with a couple keyboard strokes, your credit cards are shut down, your bank accounts are shut down. The government wants to implement a new tax like a VAT tax or a carbon cap and trade or something, or a new state sales tax or whatever. They can make a couple keyboard strokes and boom, 2 new taxes are added. And you can't protest them. It's already added, already taken out of your paycheck or any economic transaction, even if I just bought you lunch and you paid me back with the government issued crypto. I hope I'm wrong about this, Gordon, but I think that's the way things are headed.
I think you describe about a page and a half I wrote in the thesis paper what you should look for. You've been living too close to Washington for too long. Jason, you're absolutely right. That's what you should fully expect, some form of that. And you're not being a conspiratorial person at all. This is just the realities of how large institutions and status quo react. If I could back up for just a second, Jason, I was mentioning other things to invest in. People need to pay attention. Listeners need to pay a lot of attention. There's been nobody under bigger stress than the pension plans. I mean, they're totally underfunded, massive issues, et cetera. But they're not buying more stocks right now. They're not buying in the bond market. If you really look at where their growth is, and it's been a dramatic shift, they've moved to private equity. And I don't mean private equity in terms of the hedge fund like companies, but private places that are raising private placements of money. And there's no limit out. Unfortunately, in the United States, you have to be an accredited investor to get into them. In Canada, they've started to free it up that allow a certain percentage of your portfolio. But the money is moving in big time into these areas. So they're not exchange traded. So they're not as liquid. They're longer term investment. Their returns are there because they're looking at anything that can be, they're looking at anything that's on an exchange, stock exchange, bond exchange, or whatever. Well, traded through the banks, but as being too overly leveraged right now. So they're looking for places that have much less leverage that can weather a storm in a difficult time. And I'm using that as an example to say people are looking outside of this highly leveraged, fraught with risk environment and not even wanting to gamble, but they're investors. They're not, that's not speculators and gamble. You have to decide what you are. Are you an investor? And if you can't do it with a spreadsheet and put in all the risk mitigations and figure it out, then you're not investing. It's hard work.
Well, I hope the U.S. gets back to more entrepreneurship. So, Congress was supposed to open up the laws with more crowdfunding for entrepreneurs. I would like to see that because ultimately that's what's going to help the economy is people starting either growing or starting new small businesses. So that's where the majority of the jobs are created. They're not created from large corporate tax cuts normally because corporations, what they normally do is they buy back their stock, they pay out a partial one-time dividend or things like that. Because normally when the corporations cut jobs, that's when their stock price goes up, unfortunately. So that doesn't really help the real economy that much. For the guys on Main Street, I would like to see more entrepreneurship, but that's central planning isn't really going to fix that. There needs to be more small micro solutions to that.
It's always a solution. You got to harness the individual with their creativity and their innovations. Big institutions don't tend to do that. They suppress it because they want people to conform. And so you've got to free them. That's what built America. That's what's built every successful nation. And you stifle it with regulations and rules. And as a corporation, the first thing you want to do is, Warren Buffett, you want to put a moat around it, right? You want to protect, you want to lock other people from getting in, reducing your prices and your margins. And the best way to build a moat around your product today is something called regulatory arbitrage. Use the government's regulators to, if you can get your lobbyists and your politicians to get written into these gigantic bills with 20,000 pages, a paragraph or two that gives you an unfair advantage. There's more money to be made there than building a lot of factories. So that's the world of crony capitalism that we've deteriorated into, and it's to be expected when you financialize the economy to the degree that we have. And my friend Richard Duncan says we're not in a capitalist society anymore. We're in a credit cycle, or creditism he refers to it as. And that's a whole discussion into itself. But it's not to be negative here. It's just the realities of how economies and the world is changing. but not to recognize how it's changing and not to make changes to, as we started here, institutions and governance, et cetera, to accommodate this is the flaw. We're actually, the biggest central problem in my mind is lack of leadership right now, Jason. And by leadership, I mean politicians who are not pandering to populism of a free lunch or get it fixed or expediency, but have the abilities to articulate complex issues, very simple, that are a little longer term but are better solutions. We don't.
Well, no one wants to tell someone bad news that, there's going to be a financial crisis right around the corner. I mean, Trump did run on some of this.
Yeah,
so Trump was saying that he said it. He said kind of the stuff that you and me are talking about now. He said in order to get elected. Now look at him. He's taking credit for the stock market rising. He's talking about how well the economy is doing with the GDP. So, he said, I think more of the truth when he was running as candidate Trump, and now as President Trump, I think it's the exact opposite of what he said as candidate Trump. But I think there's a long-term bull market in corruption. I think there's a lot of people that have, and it's not just the United States, it's all over the globe. There's just liars and cheaters and thieves and a lot of large corporations and governments now. And in the United States especially, there hasn't been rule of law for a while, where if you committed fraud or felonies and stuff, you knew you were going to prison for a long time.
When there's no real growth. When there's no real growth and you're not really increasing the standard of living, and we're not right now, you can tolerate inequality and corruption. But when you have a trouble, your standard of living's not, you start to get social unrest because the social contract's breaking down and the public rises up. In parallel, what happens, because the money's easier to be made that way, crony capitalism and corruption starts to run rampant. When was the last time we broke up a monopoly here in the United States? And don't tell me for one moment that we don't have multiple monopolies operating here. I spent almost 12 years at IBM as they tried to break up SUP as a monopoly. And I'll tell you, if we had some of the monopolies I see today, we could have made a fortune. But that's what's going on today. We didn't have a monopoly. But
the monopolies are the social media companies. We got Google.
You got it.
Google, Facebook, YouTube have 99% of all the online advertising revenues. 99%. And if you do or say something wrong, I've heard secondhand information. Friend of a friend, I was told that someone who had a high traffic website in our space who writes investment articles, and Google told him, the friend of a friend told me this, Google straight up told him, we will put bad ads on if you continue writing these articles, we'll basically demonetize your website. So he did what he was told because he was making a living doing it. So we live in very perilous times with it's not even the government's really doing the censorship now. It's the large politically biased corporations that are monopolies doing it now. Very scary times. Well, Gordon, this has been an absolutely fascinating discussion. We are well over an hour here, so we're going to get some people complaining, although hopefully, yeah, so we've had a very fascinating conversation for well over an hour now, Gordon. I want to thank you again for your time. If our listeners want to follow more of your work or listen to your podcast, how do they do so?
Oh, yeah, absolutely. Thank you, Jason. I have one site now, Mata, SIMATASI.com, and I recommend that they sign up free on our site. There's a lot of information for our new thesis paper. That is the New World Order, and a vast amount of things we talked about today here, Jason. In some ways, we talk and try and link it together on this evolution that we're in the middle of. It's free, and I always look for great feedback from people.
Excellent. Well, hopefully. Let's plan on having you back on in the next 4 to 6 months, and we'll get a progress report. I think 2018 is going to kind of be the year that a lot of, especially gold bugs, were thinking would have happened years sooner. I think gold has probably put in a bottom. Maybe the cartel will keep the prices capped for a little bit longer, but I think the fireworks are going to start in 2019. I don't know if everything's going to crash, but I think the fireworks are going to start.
It's going to be 2017 was exciting. Hold on to your hat. Strap. My dentist has a sign that says, sit down, strap on, and hold on. and and that's what's going to happen. But if you pay attention, this is when the big money is made. Truly, it's difficult times, but that's the big money. But you've got to really listen to people like yourself on your podcast, because you're bringing a lot of great people. You got some good insights. Of course, the investment comes down to them. To the individual, but if you really listen and pay attention, some of these things become fairly obvious. Not all of them. There's so much gray area. Don't touch them. But you only need one good idea a year, to make a lot of money, Jason. That's my experience over a lot of years. Don't try and do too much. Just find one nugget every 6 months or every year. Put it away, go look for another nugget, and if you do that, you don't speculate, you can make an awful lot of money. And let time and that magic of compound interest make the money for you.
I'm a really big fan of the KISS principle, the keep it stupid.
Yeah, absolutely.
Keep it simple, stupid.
Yep. Anyway, I'll talk to you again. Jason, thank you very much for having me. Really, I always enjoy our conversations.